Hello everyone. In this session, I am going to talk about an article which is a part of FRM Part 2 curriculum as a part of the current issues section for the year 2017. So, what I am going to cover from this article is the aim statements that GARP has typically given as a part of the curriculum. But for getting a full understanding of the article, I suggest you to download the article and typically read through it so that you get much more insights into the article. So the article talking about the market liquidity, is it really resilient or is it fleeting? Within which I am going to look at the various factors that are going to affect the level of market liquidity as well as the degree of resilience that exists to market liquidity. What are the various factors and how they are really contributing to the level as well as the resilience of market liquidity. Similarly, the various drivers of the market liquidity and the resilience and what are their typical effects, how they are really impacting the liquidity. Then a few points covering the monetary policy and its effects on market liquidity. And interesting point is the liquidity spillovers from one market to the other market. So how is this spillover really affecting the various markets and the global economy per se? And what are the various recommendations to bolster the level of market liquidity and its associated resilience? So these are the various topics that we are bringing in as a part of this session. Now, coming to the various factors that are impacting the market liquidity and the degree of liquidity resilience, some of the important points that I want to bring out. The prices associated with the various corporate bonds. They impact the consumption as well as the investment because the bond prices are lesser. There is a good chance that people are investing in them, and for those who have already invested in the bonds, if the bond prices are going lesser, it is impacting their portfolio quite heavily. And at the same time, bond market is comparatively less risky vis-a-vis the corresponding equity and the property markets. So when the risk levels are much higher, there is a lot of movement towards the bond market. So overall, if we see compared to the equity and the property markets, the bond prices, they are affecting the consumption and the investment very heavily. So the macroeconomic stability is really achieved or broken through the bond markets itself because the interest rates play a very significant role in the bond market, and they have the major influence on the overall consumption and the investment levels within the economy. So they really play a very pivotal role not just in the macroeconomic stability of the country but also in the financial stability, because the interest rates play a very interesting role even in the repo markets. The repo rates and the reverse repo rates, the overnight lending rates, they all typically bring about a financial stability or even hamper the financial stability in the repo market. So they are very closely related to the funding liquidity. The interest rates play a very major role in the funding liquidity market. And we all know that the bond market is the medium through which the monetary policy of the government, because again the monetary policy is also the major role in the monetary policy is the interest rates. Interest rates again are affected through the bond markets. The first drivers on the interest rates of the bond market. So the market liquidity is also getting affected. The monetary, so because the bond markets are impacting the market liquidity, it means I can very well say that the monetary policy, which is playing around with the interest rate, is impacting the bond markets, and that is where the market liquidity is also getting impacted, which means the overall bond markets are really playing an important role. So one of the major factors which are impacting the level of both funding liquidity as well as the market liquidity. But what has been typically observed is the market liquidity indicators are very high for investment grade bonds compared to the junk bonds or high yield bonds or emerging market bonds. So the liquidity is very high with investment grade bonds. So any kind of modifications to the interest rates either through the monetary policy, they will impact the high investment bonds first of all, and that will get percolated to the other types of bonds. So apart from the bonds, especially the high investment grade bonds, even I see various cyclical factors impacting the liquidity. So any of the cyclic factors, right, probably many of the economic variables we see, they are cyclical in nature. So when we are looking at the changes in these cyclical factors, we can very well predict the shift in the liquidity aspects as well. So when you see that the economy is really in an expansion kind of a phase, the liquidity is much better, the liquidity risk is much lesser. But when the economy is going more and more into a recession phase, which is again a kind of a cyclical event, we see that the liquidity gets pretty much hampered. So by knowing the cyclical factors and how they are impacting the liquidity, we can very well predict those cyclical factors because they occur in cycles, and correspondingly we can even talk about how the liquidity could be impacted because of those cyclical factors. So if you look at the investor risk appetite, it keeps changing. The macroeconomic factors, they are all cyclical in nature. The investor risk appetite is also more and more cyclical because in the young age, the investor is more of risk taking, but as he goes older and older, the risk taking capacity goes much lesser and lesser. Even the way the monetary policy, the interest rates also up to a certain point, they keep growing up and up and up, and after that they start a downfall. Once they go down and down and down, again they start an upward movement. So you could see all these things are cyclical in nature, and we can very well predict the impact of liquidity during each of these various factors. And even there are regulatory related reductions in market making process, so which has impacted the market liquidity very heavily. So the market making behavior has gone down, which means the market liquidity also has gone down. The more and more restrictions coming up on the leverage, even the market liquidity is getting frozen quite heavy. So many restrictions with respect to the derivatives trading that has been imposed by the European Union. So more restrictions, the weakening of the liquidity. Let's understand that restrictions could have an impact or could have a positive impact with respect to risk management, but at the same time we need to understand that more and more restrictions, they are weakening the liquidity of the underlying assets. Right, more restrictions being brought in, the liquidities are getting very heavily hampered. And even the other way of looking at it, the transparency in the transactions. If you look at the OTC derivatives earlier, they carried very heavy amount of proprietariness, which means the transparency is very much lacking, was very much lacking in various derivative transactions. But if there is an increase in the transparency, the liquidity is bound to increase. More and more transparent transactions, the liquidity, the more number of buyers and sellers coming into the market is going to increase. More matchings can be done with the buyers transactions, between the buyers and the sellers transactions. Even the uncertainty regarding the asset values can quite heavily be eliminated or reduced because of the transparency getting increased. So we need to understand that there are various factors that are impacting the level of market liquidity, and we need to strike a balance between the rigidity of the regulations and restrictions versus the improvement of liquidity in the market. Now look at some of the major investors, right? Let's say mutual funds, they invest very heavily. They have large amount of holdings. Right now, they don't keep trading quite often, so they keep holding huge amounts of securities. Now, there is a huge concentration of a few securities or a few sectors among the mutual funds. Similarly, pension funds also, they concentrate on a few sectors or a few specific securities. The same logic goes with insurance companies. They make the liquidity less resilient. So they are all associated with less resilience, liquidity. So monetary policy has a very positive impact on the market liquidity, but at the same time, so if the more and more easing is resulting in increasing the market liquidity, but at the same time the liquidity risk can also come up because of heavy liquidity. Liquidity at this moment can result in freezing of the markets at a later point, because more number of transactions are coming into picture. Large volume can result in a scenario going illiquid in the future. That's exactly the same thing that we have observed during the financial crisis. So the funding constraints will get relaxed because of the monetary policy. So the financial intermediaries start raising more and more capital. If the monetary policy is relaxed, we see that the funding constraints will be removed. The financial intermediaries will be able to borrow quite comfortably. So the moment they start borrowing, their risk appetite, their leverage increases, their risk appetite will increase, and the market liquidity at this moment can typically will not be exist at all, but at the same time in the future that can very well impose a liquidity risk as well. So the resilience as well as the level of market liquidity needs to be to be understood together. If I look at the various drivers of market liquidity and resilience, we have already talked about the risk appetite playing an important role, the funding constraints. No constraint at all means the funding liquidity is much higher. I'm able to raise capital to any extent quite comfortably. The more the risk appetite, I'm ready to invest in almost any kind of securities. I'm ready to borrow to any extent. And the various market risks, the more the market is volatile, people may be restricted in terms of investing in a few sectors altogether, right? And but at the same time, the more volatile a particular market is, there is a good chance that I can buy at a cheaper price and sell it at a higher price. So all these things, they really decide how the financial institutions are inclined towards providing the liquidity services. To what extent the financial intermediaries and the various players in the market, they are willing to take advantage of the arbitrage. Look at the mispricing of the assets and make their buy-sell decisions accordingly. So these are the various drivers. Let's say if the funding constraints are very, very tight, right? The funding is almost not available, which can be because of the regulatory aspects, or in some cases because of very, very heavily risky business models that have been adopted, right? If the funds are not there, obviously the risk taking capacity is going down for the financial intermediaries. Sometimes they will be unwilling to lend itself. They don't want to make markets by borrowing and lending because the liquidity is not that effective. So various proprietary trading activities of the bank will get badly affected. If the funding constraints do not exist, all these things, right? The dealers will start taking n number of risks. They don't mind making markets, buying at one rate, selling at another rate. So the bid ask spreads, even though they are narrow, they would like to make the market with respect to the volumes, and they can very well play around with their proprietary trading activities as well. So the tighter the funding constraints are, which will create market liquidity because or even the funding liquidity, because the banks and the financial intermediaries, they will not be in a position, they will not take the risk to typically do the lending process, and proprietary trading activities will get badly impacted. So the market making becomes much lesser. So the buyers and sellers matching is not happening, which means the search costs are increasing quite drastically. So that's one major driver. The other thing that I'm looking at is the search costs itself, which we are talking about, how quickly we are able to see the matching between the buyers and sellers. How quickly the buyers and sellers are able to find each other. Now, if there is a huge amount of transparency, probably it's much easier to match buyers and sellers. So the overall search costs are going to go down. But if there is some kind of a restriction or a ban on some kind of products, just like the way we have European Union banning uncovered sovereign credit default swaps, obviously if one particular product altogether is banned, searching for a similar kind of alternative, searching or matching a similar kind of a portfolio would be involving huge amount of costs. So that's one more place where we could see that the cost could be much higher. Today we see lots and lots of electronic trading. I should really understand that the more and more transactions are virtual, the more and more electronic trading has come into picture. I should expect that with the volume, the search cost should typically go down. But what is happening is their implications are still unclear. So if the trading that is happening, this electronic trading that is happening, if it is really getting performed for demanding immediate liquidity, or various algorithmic trades are typically being performed which are very poorly designed, even they will have a very negative influence on the overall liquidity. Even the search cost will go up in that case, resulting in increase in illiquidity as such. So we need to know what is the implication of the electronic trading platforms, how the algorithms are designed, before saying whether the electronic trading can really improve the market liquidity or it will hamper the liquidity. The investor characteristics, they are impacting the market liquidity very heavily. So the various constraints that the investors are having, the various mandates that they are having, the kind of access to information that they are having regarding the various securities, it will obviously impact the market liquidity level as well as the resilience aspect. And if you look at the large scale purchases, the central banks do a buying and selling of the securities on a large scale based on their unconventional monetary policy. So it will have a mixed effect. First thing, the funding constraints are getting relaxed, so there's a positive effect. Right, which means at the same time the moment the funding constraints are getting relaxed, the risk appetite is getting increased, so overall liquidity is becoming more higher. But at the same time, this can very well, if it has bought huge amount of bonds, so the supply of the certain types of bonds are going down in the market, So because of which the liquidity can be affected for those specific asset classes, and surging costs are getting very much increased in the process. So they can the large scale purchases that the central banks are doing will have either a positive impact or a negative impact depending on what is the way the transaction is getting structured. So if I could simply summarize these aspects. So there is a macroeconomic environment, monetary policy, which are driving each other. The current macroeconomic environment will drive the market policy, the monetary policy. The monetary policy in turn is impacting the macroeconomic environment. Similarly, technology is a major driver. The electronic trading platforms, etc. They are again a major algorithmic trading. They are the major drivers of liquidity. The regulation. So if I look at it from these dimensions, macroeconomic environment is very much impacting the risk appetite, right? The GDP is higher, the economy is growing, the risk appetite of the individuals is going to be much higher. Whereas in a recessionary kind of an environment, I see the risk appetite levels to be much lesser. Similarly, monetary policy. If the interest rates levels are much higher, the savings and the investments are going to increase. Whereas if the interest rate levels are much lesser, the borrowings and the consumption is going to increase quite heavily. So both monetary policy as well as the macroeconomic environment, which are interdependent among each other, they are going to impact the risk appetite. And risk appetite is going to play a major role in the day-to-day liquidity aspects itself, because the more the number of securities bought or sold, liquidity is getting higher, and the lesser the number of transactions, the liquidity is getting frozen. Similarly, if I look at from a monetary policy perspective, funding and market making, the more relaxed the monetary policy is, the funding is going to improve, the market making is going to improve, which will impact the day-to-day liquidity quite heavily. Whereas the more regulations coming up, the more and more stringent the regulations are, they are going to impact the funding process. So the capital raising becomes very difficult, market making becomes very difficult. So the red is showing it will impact negatively. So because of which I could clearly see that the day-to-day liquidity gets very badly affected. So which is very much true. The more technology, it should facilitate the funding and the market making process more easier, which should lead to more heavy liquidity. Similarly, the technology, if I talk it from the perspective of search costs, monetary policy is impacting the search costs, right? Depending on how liberal is the market monetary policy, the more, and if the interest rates are much lesser, then the borrowing chances are much higher. So the matching between the buyers and the sellers is pretty much possible, which results in search costs going much lesser. Search costs going lesser is an indication that the liquidity is getting improved overall. Similarly, technology should match the buyers and sellers quite comfortably, reducing the search costs. Even the regulations, if I see the regulations also should reduce the search costs quite comfortably. Coming to the investor base, monetary policy has an impact on the investor base. Again, how relaxed the monetary policy is, I could see that the investor base can go up, which means the market liquidity can typically go up. But regulation, the more and more regulations are there in place. If the regulations are for good, let's say the transparency, etc., the investor base can go up. But if I'm talking about the regulatory aspects with respect to the financial intermediaries, then the investor base could typically go down. That's a kind of a negative effect, which will impact very heavily the resilience of the liquidity. So I see that the investor base as well as the funding and market making, they are going to impact the liquidity's resilience aspect, whereas the risk appetite, the funding and market making and search costs, they are impacting the day-to-day liquidity. So this is a very straightforward way of understanding what are the various drivers of market liquidity and their resilience, and what is the kind of impact each of these drivers is having on the overall market liquidity process. So looking at the effects of monetary policy on market liquidity. So we are looking at the various instruments, right? If I'm talking about a monetary policy, I'm looking at the various instruments which are eligible for collateral. So the more is, so if a new instrument is included as a part of eligible collateral, obviously the liquidity for that particular product or instrument would be much higher. If a particular instrument is taken out from the list of eligible collaterals, obviously it will have a big negative impact on the liquidity of that particular instrument. So if I have to increase the liquidity of a particular instrument, as a part of the monetary policy, I should include that instrument as a part of the list of eligible collaterals for the repo transactions. So generally, highly rated kind of securities are being permitted as a part of the eligible collateral for the various repo transactions. So because there is if a particular instrument is included, so when I look at it from the cost of holding the instrument as a buffer for liquidity, it can very well stimulate the issuance in the primary market. So I know that I can keep this as collateral. I can keep this particular security as a buffer against the liquidity requirement. So obviously the demand for buying this particular product will typically go up, and that is what will increase the liquidity of that particular instrument. Similarly, when I look at the other aspect of monetary policy where the quantitative easing is coming into picture, which has been the scenario in the United States and the European countries for a quite good amount of time. Initially, it has improved the liquidity quite heavily, especially for the mortgage-backed securities, because the interest rates were much lower. There is an improved liquidity for the mortgage-backed securities, but after that, we see that again too much of it has degraded the overall liquidity in the process. So adverse effects on market liquidity. Obviously, it's a very small cost of the overall quantitative easing, but we need to understand, so the depth of the capital market and the liquidity for the monetary policy operations in a low interest rate environment. So there is a huge importance on the depth of the capital markets and the liquidity for the monetary policy operations, especially when the interest rates are very lower. Even the heterogeneity of the investor base, the more the heterogeneity it is, the more diversified. So if more or less all the investor base is similar, even that is causing a big deterioration in the liquidity. I need different kinds of investors, a good amount of risk takers as well as good amount of risk averse investors. The more is the spread out, right? I need to typically have the investor base more and more heterogeneous, which is more like a diversification. I will have a good pool of risk takers. I will have a good pool of risk averse investors. So more buying, sellings happening. Otherwise, I see only more buy orders without any kind of sell orders and vice versa. So the overall liquidity will be deteriorated in the market. Apart from all these things, we have already discussed the changes that are coming to the market making from the regulatory perspective. The structure of the markets is also impacting the market liquidity. Various regulations, various monetary policies, they have been continuously impacting the market liquidity very heavily. Apart from these, we also need to talk about the liquidity spillovers, the way they got amplified. We know illiquidity is majorly through the financial stress, right? In the financial markets, now that has getting spilled over to the asset classes. various other asset classes like bonds, stock, or even properties, gold, commodities. So they're getting completely spilled over to various other asset classes. So the liquidity shocks that are coming up on one or few assets, they are getting propagated to other assets, even if those assets have not much of a relationship with the current asset base, which is subjected to liquidity, even if the fundamentals are unrelated. So if you see the primary reasons, the marking to the market, and the rebalancing of the portfolios that need to happen every often. So obviously, because of these things, there are huge restrictions or huge constraints that are coming up on the ability to trade and hold other assets. So the liquidity shock on one or few assets is immediately getting transferred to, is immediately getting spilled over to the other asset classes. So even trading in the other assets is also becoming difficult because of this, because of the concept of marking to market. So if the market participants are very heavily leveraged, obviously they are losing very heavily on one of the asset classes. So even holding the other classes is becoming a very difficulty. So there is a huge amplification, especially when the leverage is much higher. And even if you look at the correlation, if the correlation between the various asset classes is much higher, I could see that the spillovers could be much larger, because there could be on one of them, if there is a huge drop, there could be big fire sales resulting in almost negligible prices. And there is also a thought process, because all the assets are very much correlated. The impact of one asset could have a serious impact on the other assets also. So all the all the assets will get sold off or get into a fire sale process. So overall liquidity is completely frozen up in the process. So any amplification of the liquidity spillover to the other asset classes is further damaging the liquidity in the business. The spillovers are observed that very high during the stress periods, especially when the economy is not growing as per the expectations. Nowadays, we are seeing that more and more frequent after the 2007-8 financial crisis. We see that we have been seeing that spillovers have been much heavier. One market impacting, the effect is quickly getting percolated to various other markets as well. So especially when the returns are very low, but at the same time they are volatile, it's very easy that the spillover can go from one market to the other market, one asset class to the other asset class quite quickly. And then currently, if you look at it, that's the situation the global markets are facing. And we understand that when we are talking about various asset classes, there are many common factors that move the liquidity across the asset classes. There is a lot of correlation between the various asset classes. So those common factors are really playing a role in the co-movement of liquidity across the classes. But what is typically observed is, generally the overall shocks, they are starting from the investment grade bond market, and from there they are starting on to pass, they are getting passed on to other markets like high yield bonds, emerging market bonds, and even to the other asset classes as well. That has been the historical observation which is mentioned as a part of this article. And a few recommendations, if I have to really bolster the level of market liquidity and resilience, what should be the role of the policy makers? They should adopt various preemptive strategies to really deal with the sudden shift in the market liquidity. They have to identify, and based on that they have to come out with measures on, if the market liquidity is getting seriously shifted by large volume, what are the various action plans? They should keep monitoring the market liquidity condition on a real-time basis at regular intervals for various asset classes, using different kinds of transaction-based metrics, and based on that they need to have a continuously monitoring model for the market liquidity aspect. Now, when we are talking about electronic trading technology, there is a possibility that new market makers are coming into picture. Because of that, new asset managers are coming into picture. So which means there is a possibility of increase in market liquidity because of different kinds of players coming into the market. Now what we are saying is all of these should have access to the platforms on equal terms, and that is what could facilitate the improvisation in the market liquidity process. Transparency, improving the transparency in the capital markets, standardization of the various financial instruments, all these things can really increase the market liquidity. Now, restrictions on derivatives trading, we have already discussed that they are going to impact the market liquidity. So, they really need to be evaluated, and based on that, some modifications need to be brought out to those kind of stringent restrictions that have been put up, so that the liquidity can be improvised to some extent. And all the side effects that are bound to occur because of market liquidity, because of the policies which are being implemented by the central bank, even based on the collateral related restrictions that they have put, what kind of securities can be included as a collateral and which securities are excluded as collaterals for repo transactions, or even their purchases, their buying and selling of the assets, resulting in either increasing of the liquidity or decreasing of the liquidity. So while the central banks are typically getting involved as a part of the various transactions, they should really be mindful of the side effects of the market liquidity. So they should keep thinking on how to reduce the liquidity. One, from the perspective of mismatching the buyers and the sellers, and the first mover advantage at the mutual funds. So they need to have a clear cut process involving the same. And it's a very much a possibility now. The federal bank is beginning to normalize its monetary policy. So how smoothly it is able to implement the same, how smoothly it is able to implement so that the market liquidity does not get disrupted, both advanced and emerging market conditions as such. So how is the balancing is typically being done. So all these are the various aspects with which the liquidity and its resilience can quite comfortably be improved. So these are some of the points that I wanted to cover as a part of this article session for 2017 current issues of FRM Part 2. I hope you got a good understanding of these 5 various aim statements that have been provided. Any further queries you have, you can very well get in touch with me by giving me a call on the number that I have provided below, or you can send in an email at vamsidhar@pacegurus.com. Thanks a lot for listening to this session. Thank you very much.